Thanks for watching and thanks for staying with ET Now. Deep dive with Nikunj Dalmia. Yes, 30 minutes we would be talking about, well, the story of the day. We'll analyze it thread and bare, and we'll really talk about how that could change your portfolio, your life in today's case, your finances, your loan, and your loan tenure. What are the key highlights of the credit policy meeting? Let's first address that. First, rate cut. After 5 years, there is a rate cut. Last rate cut came immediately after COVID, which was more like an emergency rate cut, but no rate cut has come after that. Is this rate cut good enough? And we look at more highlights. There was a unanimous decision. In fact, if one looks at the credit policy and in terms of the view of the MPC committee, the real GDP growth for FY26 has been inched lower, while inflation estimates have also inflation for FY26 is estimated at 4.2, for FY25 4.8. So the RBI is indicating that both the growth in the economy and inflation trajectory will start coming down. Now, how will this change your life? When rates they go down, there is no guarantee that whatever has been cut down will automatically be transmitted, which is if you have a loan, and there is no guarantee that the real benefits would come or reach the consumer, because we look at rates which are priced on cost of borrowing and also cost of borrowing. These are two important variable factors. Now, what analysts feel the road in the near term could be, it's negative for floating rate loans, EPLR loan rates, instant repricing, and yields on loan is likely to go down. That's the context. A rate cut after 5 years, it could lead to some mild pricing. It could have an impact on interest earning segment, which is if you have a fixed deposit, but it may not lead to complete transmission. So how does the dynamic work? Let's first get a reaction from someone who really knows it all. And I mean it when I say I know it all. Every time when we wanted to understand something complicated, we would just request some time from Mr. Dinesh Kumar Khara, and he would just make it very simple for us. And that is what I think we'll attempt to do it. Mr. Khara, you're the man with all the answers.
Yeah, I think, am I audible?
Yes, sir. So a rate cut after 5 years, and the ring of it is great. Now, if a 25 bips rate cut has been done, what does that mean?
Well, I think it's a very clear reflection in terms of the inflation trajectory, because as far as RBI monetary policy is concerned, we have been having a inflation targeting as one of the core principles. And it very clearly reflects that inflation is under tolerable band. And that's why this kind of a interest rate cut policy rate has been announced today. So I think it's a broad direction to the market. And eventually, whether how much of that will eventually get passed on will be a function of the cost of funds for each of the bank. And before that, I would also like to highlight that some of the loan book, some of the components of the loan book are linked to the external benchmark. But those external benchmark, if at all they happens to be the repo rate, then perhaps it will have an immediate transmission. But if those external benchmark happens to be the MCLR, so then perhaps, how much of this interest rate cut will have an impact on the MCLR will probably decide the likely transmission of this interest rate cut. So that's how I read it. And also the other aspect is that the cost of funds for the bank is a function of the cost of deposit. But that happens to be the major source for any bank to operate. And we have seen that in the past, the cost of deposits have actually gone up significantly, which is also a function of the liquidity status in the market. So I think considering the fact that the loan growth was outpacing the deposit growth, and many of the banks had gone into the trajectory of about 80% odd credit deposit ratio. Some had gone even as high as 90-95% also. So naturally, the market had seen some such players who were clamoring for deposit at any cost. So that actually led to a scenario where the market interest rate, at least for the deposit, went up significantly. So I think the ability of the bank to pass on will depend upon their portfolio, their composition of the portfolio, and the benchmark which they have adopted for the variable rates or the floating rates loan book. So that's what my overall sense is.
Khara, where the transmission is slightly more active, is it with private banks? Is it with PSU banks? Is it with large banks? Where the transmission is highest and fastest?
No, I think as I mentioned that if at all banks have adopted the repo as their external benchmark, there it will be the fastest. There the transmission is going to be the fastest. They may not be in a position to reprice their deposits immediately because deposits will get repriced with a lag. Loan book, if at all linked to the repo, will get repriced immediately. So, and deposit in any case, the fresh deposit, whichever is coming, and if at all, this kind of a reduction in policy rate will have an impact on the overall interest rate scenario in the market, which of course to my mind is only one factor when it comes to repo rate. The other very important factor is the liquidity status in the market. So I think that will be the deciding factor.
Deposit rates, Mr. Khara, will we see an immediate cut in different tenures of deposit rates because of this RBI rate cut?
Not necessarily. As I mentioned that if at all there is a challenge in the asset liability composition of various banks and they have to address that gap and they might continue to pay even little higher to mobilize those deposits.
Then how will RBI's 25 rate cut help the economy? I'm asking you very basic questions because if the transmission does not happen, it depends on the banks and what policy in terms of MCLR and cost of liability is. If deposit rates may not just come down, do you think 25 bips is just a signaling and it may not really have a large impact?
It is very important as far as the signaling is concerned. And the way I read it, of course, MCLR will also at some point of time will start really readjusting to this changed reality. And with that, particularly the way I look at it is, it will get passed on to, particularly for the SMEs in particular, their loans were required to be linked to the external benchmark. And majority of the banks have got their MCLR as the external benchmark. And which means that for the NBFCs, etc., who happens to be into the SME bracket, so they will have the benefit of the lower interest rate. Maybe it might differ from 3 to 6 months depending upon each of the bank when they will start factoring in this impact in their MCLR interest rate. So I think it would actually enable these NBFCs to borrow at a little lower interest rate from the banks, which eventually means that at the ground level, the interest rate might come down. So that's the sense which I get.
The comments on liquidity and a specific comment that we are there to ensure enough and more liquidity is there in the system. Apart from just providing overnight liquidity, we will also give other forms of liquidity. Is that a good enough message for markets to breathe a sigh of relief?
I think it's a very welcome message. Well, of course, the fact remains that when it comes to as far as the banks are concerned, they would have been probably looking at the reduction in some kind of a CRR. And with the reduction in CRR, the preemptions would have got reduced and the lendable resources would have gone up for the banking system also. But now today, by virtue of the statements which have been given by Governor RBI in terms of easing of the liquidity, both the durable liquidity also, he has indicated that there will be enough durable liquidity. And in a way, he has sort of indicated that the call money market where the participants are not really coming with full vigor and probably the depth of the call money market is not seen as much as it should be. Maybe that is something which will really help in cooling down the call money market in the days to come. and again raising through repo and lending through in the call money market, which was apprehended to be a cause of concern for many of the banks. Even that is attempted to be addressed through this process. So I think eventually the way I look at it is that one, of course, trap is it happens to be the secured market, whereas call money market is unsecured. So, but at the same time, the players and traps are many more, and also the banking system and the other players. Now the size of the other players have also gone up significantly. Banking system is about 200 odd trillion as far as deposits are concerned, and similarly mutual fund would be about 70 trillion. Likewise, insurance would be around the same level. So which means that, and as compared to that, in the call money market, it is only the banks which are paying. So naturally, the depth being very low in case of call money market is one of the reasons why the call money rates are invariably on the higher side. So that is one aspect which is intended to be addressed by RBI Governor. That is it's a very important source. Call money market is a very important source to address the short-term liquidity for the banking system. So people should actually make use of that. That is intended.
So, Mr. Khara, there are two ways to stimulate the economy, fiscal and monetary.
Yeah.
Government has supported the economy on the fiscal side with a huge tax cut. Reserve Bank of India is now opening the liquidity tap and is also loosening the interest rate cycle. So can I say that these interventions, in a sense, will ensure that the economy which has gone off track, 7.5, which has become 6.5, soon could be above 7?
Well, I think there are a couple of more explanations which have been given by Honorable Governor in the press meet today. One is essentially relating to the LCR, the other one is relating to ECL provisioning, and third one is relating to the project loans provisioning. So I think when it comes to the growth initiatives of the economy, even these measures matter quite a lot. That has also brought in there was some kind of overhang on the mind of bankers when it comes to LCR, when it comes to ECL, when it comes to project finance provisioning. So at least that has been taken away, and also it has been indicated that there is going to be enough exchange of ideas between the banks and the regulated entity and the regulator. And after that, these guidelines will be tweaked or will be sort of initiated into the system. So I think even that is going to work very well, because otherwise, if at all, when it comes to lending, if at all bank is required to make 5% provision maybe in 3 years' time, so naturally the cost at which they can lend, it will automatically go up. Now, at least with this kind of some kind of a reassurance which has been given by the Honorable Governor, probably these aspects will also get addressed, and also the LCR aspect also, which eventually have a cost, has an impact on the cost of funds. Even that will also get addressed. So I think what I say is that apart from the reduction in the policy rate, even these initiatives will also go a long way in terms of creating a favorable environment for encouraging the growth in the economy.
Always a pleasure. Thank you so very much for joining us. And like I said, that every time when you want easy answers for difficult questions, well, Mr. Khara is the right man.
Thank you. Thank you very much, Dipam.